State Pension UK. Why 45% of people don't get the full amount. 45% of people on the new state pension do not receive the full amount. Most of them have no idea, and most of them could have fixed it if they had known what to check. Here is something that puts the state pension in a completely different light. The full new state pension from April 2026 pays £241.30 per week. That is £12,547 per year for the rest of your life. Guaranteed, rising every April through the triple lock. Most people look at that number and think, fine, but it is not exactly life-changing money. But try buying that income privately. If you walked into an insurance company tomorrow and asked them to provide you with £12,547 per year for the rest of your life, fully inflation protected, starting immediately, they would quote you somewhere in the region of £200,000 to £250,000. That is what a private annuity, paying the equivalent of the full state pension, would cost you to purchase today. That is the real value of the state pension, not the weekly figure, the capital equivalent. And when you frame it that way, as a £200,000 asset that you may or may not fully own depending on your national insurance record, the stakes of getting this right become immediately clear. Every week of state pension you are not entitled to is not just a few pounds short each week. It is a piece of that £200,000 asset that you are leaving behind. Now let me explain why 45% of new state pension recipients do not get the full amount, and the two reasons that catch people most by surprise. The new state pension was introduced in April 2016 for anyone reaching state pension age on or after 6th of April 2016. To receive the full amount of £241.30 per week, you need 35 qualifying years of national insurance contributions or credits on your record. To receive any state pension at all, you need a minimum of 10 qualifying years. A qualifying year means that in any given tax year, you either earned above the lower earnings limit, currently £6,196 per year, paid voluntary contributions, or received national insurance credits through things like claiming child benefit for a child under 12, receiving certain disability or carer benefits, or being registered unemployed. The first reason people fall short is gaps, career breaks, periods of part-time work below the lower earnings limit, time abroad, years of self-employment with modest profits, or caring responsibilities where child benefit was not claimed or was claimed by the wrong person. Any of these creates a gap year, a year that does not count toward your 35. But the second reason is far less understood and catches people who believe they have plenty of qualifying years completely off guard. It is called contracting out. If you worked for an employer that ran a final salary or defined benefit pension scheme between 1978 and 2016, there is a very good chance you were contracted out of the additional state pension, the extra layer on top of the basic state pension that existed before the new system. Being contracted out meant you and your employer paid lower national insurance contributions. In exchange, your employer's pension scheme was supposed to provide equivalent benefits. When the new state pension launched in 2016, HMRC calculated a starting amount for everyone based on their record under both the old and new rules. If the old system, including the additional state pension, would have given you more, they used the old figure. If the new system gave you more, they used the new figure. The higher of the two became your starting amount. But here is the catch. If you were contracted out for many years, your starting amount may have been significantly reduced to reflect the lower national insurance contributions paid during that period. And even if you have 35 or more qualifying years on paper, your new state pension may still be below the full amount because of this contracted out deduction. This is why someone can look at their national insurance record, count 38 or 40 qualifying years, feel reassured, and then be surprised when their state pension forecast is lower than they expected. The number of years is only half the picture. The contracted out deduction is the other half. Now here is the 5-minute action that I genuinely recommend every person watching this video takes today rather than later. Go to gov.uk and search for Check Your State Pension. Log in using your Government Gateway account, the same login you use for HMRC self-assessment or pay. If you do not have a Government Gateway account, creating one takes about 10 minutes, and you will need your national insurance number and either a passport or a recent payslip to verify your identity. Once logged in, you will see 3 things. Your state pension forecast. This is the weekly amount you are currently on track to receive based on your existing record. If it is below £241.30 per week, there is a shortfall. And it is worth investigating why. Your full national insurance record year by year, every tax year from when you started working, will show as either full, partial, or a gap. Any year showing as a gap is a year that did not count toward your 35. Partial years are years where you contributed something but not enough for a full qualifying year. Your state pension age. This matters because it is changing. It is currently 66 and is rising to 67 between 2026 and 2028. Check yours specifically, rather than assuming. Write down your forecast and note every gap year on your record. Pay particular attention to gaps that fall within the 6-year window you are still able to fill. Under current rules, you can generally buy back qualifying years going back 6 tax years. Every year beyond that is closed. The window moves forward by 1 year every April, which means checking your record and acting promptly is not optional if you want to preserve your options. If you are in a contracted out pension scheme at any point, call the Future Pension Centre on 0800 731 075. They can explain how your starting amount was calculated, confirm whether additional qualifying years would increase your forecast, and tell you the exact cost and benefit of filling any specific gap year. This call is free, it takes around 20 minutes, and it will give you the precise numbers rather than estimates. Let me give you the maths, because this is where the opportunity becomes very difficult to ignore. Each additional qualifying year of national insurance adds approximately £6.89 per week to your state pension. That is the full weekly amount of £241.30 divided by 35 qualifying years. Over the course of a year, that is approximately £358 of additional pension income. The cost of buying a Class 3 voluntary qualifying year, the standard rate for filling gaps, is currently around £824. Divide the cost by the annual income gain. Your payback period is approximately 2 years and 4 months. 2 years and 4 months. After that, every single year you are alive and receiving your state pension, that £824 investment is generating a net return. On a 20-year retirement, a single missing year that costs £824 to fill returns approximately £700 in additional state pension income, before accounting for triple lock increases that will push that figure higher in real terms every year. And remember that state pension income is triple lock protected. It rises every year by whichever is highest: inflation, average earnings growth, or 2.5%. A level annuity erodes in real terms over time. The state pension does not. The net gain over a 20-year retirement per missing year fills somewhere between £5,000 and £8,000, depending on triple lock assumptions. On 2 or 3 gap years, you are looking at a potential £10,000 to £24,000 in additional lifetime income for an outlay of £1,648 to £2,472. Before you pay anything, confirm with the Future Pension Centre that the specific gap years you are looking at will actually increase your forecast. Not every gap year translates into a higher pension, particularly if you have already reached 35 qualifying years under the standard calculation, or if the contracted out deduction is the limiting factor rather than your year count. Always check before paying. Here is the part of the state pension that almost nobody talks about, and it matters more right now than at any previous point in the last decade. The state pension is taxable income, every penny of it, but it is paid gross, meaning the Department for Work and Pensions pays the full £12,547 per year directly into your bank account with no tax deducted. HMRC collects the tax separately, either by adjusting the tax code on any other pension you receive, or through the simple assessment process if you have no other payee income. This matters for 2 reasons. The first is that the state pension now sits £22 below the personal allowance of £12,570. The entire state pension payment sits inside your tax-free allowance. Just barely. But that gap is closing every year. From April 2027, as the triple lock pushes the state pension above £12,570, the state pension alone will generate a tax bill for people with no other income. That is a new development, and many people are completely unprepared for it. The second reason is that the state pension consumes almost all of your personal allowance, leaving only £22 of it available before your private pension withdrawals, SIP income, or any other taxable source starts being taxed at 20% from the very first pound. This is the hidden connection between your state pension and your drawdown strategy. In the years before your state pension begins, you can draw up to £12,570 from your pension each year completely free of income tax, filling the entire personal allowance at zero cost. The moment the state pension starts, that zero tax capacity drops to £22. Every pound of SIP or workplace pension you take beyond that is taxed at 20%. Understanding this interaction is the difference between a drawdown strategy that works efficiently around the state pension, blending ISA withdrawals and pension withdrawals to minimise tax, and one that simply takes what it needs and pays whatever tax results. The former keeps significantly more of your retirement income in your pocket. If you want to see exactly how your state pension fits into your full retirement income picture, how it interacts with your SIP, your ISA, and your overall tax position year by year, the Drawdown Planner Inside Retirement. Ready UK models all of it in one place. The link is in the description. Check your national insurance record this week. I have linked the HMRC page directly in the description below. It takes 5 minutes, and it could reveal a gap that is worth thousands of pounds to fix. And if you want to see how your state pension fits into your full retirement plan, watch the Drawdown video next. It covers exactly how to manage your pension withdrawals around the state pension threshold in a way that minimises your lifetime tax bill. Hit like if this was useful. Subscribe for more UK retirement planning content in plain English. I will see you in the next one.